Welcome to Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. I'm Doug Hoyes. I know that whenever I talk to someone in financial difficulty and they realize they're going to have to take drastic action to deal with their debts, one of the most common questions I get asked is, will I ever be able to buy a house? They worry that if they go to credit counseling or do a consumer proposal or a bankruptcy, they'll never be able to qualify for a mortgage. That is a real concern. Obviously, if you have bad credit, it's more difficult to qualify for a mortgage. So what does it take to qualify for a mortgage, and in particular, if you've had bad credit in the past? That's the topic for today, and I've got two guests who are experts in the mortgage industry to answer that question, one in each of my two segments today. But before we get into the nitty-gritty of this topic, let me give my standard disclaimer. Every guest on Debt Free in 30 is picked by me personally, and I've picked them because I believe they have important information to share with you, the listener. When I decided to do a show on mortgages, I put the word out to my network and asked for names of mortgage experts that my team knows and have dealt with, and that's how I found our two guests today. This show is not an infomercial for my guest services. My guests don't pay to be on the show, and I'm not paying them to be on the show. Our focus is to give our listeners practical advice. So, with that background, let's get started with my first guest. Who are you, and what do you do?
Hey, Doug. My name is Michael Steele, and I'm an active blogger, speaker, and I'm also an advisor to a select clientele on their mortgages. What I do specifically is I provide them with the tools to navigate successfully the vast and quick changing financial landscape here in Canada.
Cool. Well, thanks for being with me, Michael. So you're a mortgage agent. I guess my first question then would be, why should someone looking for a mortgage talk to someone like you? I mean, we all know banks give out mortgages. They advertise them very heavily. I assume the market is very competitive, so I assume I can get a pretty good deal from a bank. Why should someone go see a mortgage agent such as yourself?
Absolutely. That's a great question, Doug. Why should you use a broker? I'd say the number one difference between us and the retail level or how you acquire a mortgage is the level of service we provide. The way I feel a proficient broker or agent differentiates themselves is in how they position themselves as a trusted advisor on your team, just like a CPA or having a good realtor in your back pocket. And what we provide as brokers is strategies to help save literally thousands of dollars in mortgage interest over the lifetime of your mortgage. And where the rubber meets the road is in understanding the mortgage contract, how to navigate the terms and the fine print that a lot of times the banks gloss over or don't even feel they have the need or the regulatory requirement to disclose to you.
So I get that. You're saying that, the bank's there to sell their product. You're there to have a more long-term relationship with the person. You want to explain to them what the mortgage is, how it works, and then you're shopping the market to get them the best deal. So that all sounds, that sounds wonderful. It's just a beautiful thing. But let's be honest here. You are a private business person. Obviously,
right.
You're getting paid for your services, so I assume that if I get a mortgage through you, there's some kind of fees that are built into the cost of the mortgage. So doesn't that mean it's going to cost more to get a mortgage through a mortgage agent than it would cost if I just went and got a mortgage at the bank?
That is an interesting question, and it's a very commonly held but incorrect assumption that a lot of consumers hold. If we just take an apples-to-apples comparison here, Doug, and look at a mortgage that I arranged for my client at 2.9%, and at the retail branch level at Bank A, you've got a mortgage arranged for 3%. Effectively, based on the cost of borrowing, the consumer wins. That's it, period. The way banks pay brokers especially on the finder's fee is they actually pay us out of their profits to gain market share. And at the end of the day, that is just considered a cost of borrowing. And what's little and less known to the consumer is that banks actually pay other referral sources to gain market share as well. And that is also just considered a cost of doing business.
So what you're saying then is, if I'm let's start with the simple example where I'm a Class A client, I've got, decent credit, I can probably get just as good or maybe even a better deal by going through you than I would if I just went to my bank and signed on the dotted line. Is that what you're saying?
Absolutely.
Okay, so now let's talk about the person who perhaps isn't the greatest credit risk in the world. Somebody who perhaps has had some credit challenges in the past. Maybe they've gone through a bankruptcy or a consumer proposal. That process is now finished. They're in the process of reestablishing themselves. They want to then get back into the housing market. What's it going to take? And as I said at the top of the show, this is a common question that I get all the time. So let's kind of break it down then. So let's take that example. My proposal is done. My bankruptcy is done. How many years does it take before I am going to be in a good position to qualify for a mortgage? We know that if I go bankrupt, on Equifax, for example, there's going to be a note for 6 years that says I went bankrupt. If I do a consumer proposal, I know there's a note for 3 years after I finish making all the payments. Does that mean I can't get a mortgage for 6 years after bankruptcy?
Right. And just a quick caveat on the bankruptcy or post-bankruptcy qualification. In the mortgage industry, there's so much flux in terms of negative and positive trending and where exceptions are made and extenuating circumstances. So just to kind of qualify that question, because you can get mortgages post-bankruptcy that are not necessarily prime mortgages, but what we're looking to do is qualify for an institutional mortgage post-bankruptcy or proposal. So in generalities, what they are looking for is a 2-year timeline to lapse after your discharge. A 2-year timeline where you've reestablished your credit, so from the date you've reestablished it to the time and date you've talked to them. And what's less obvious, but they do look for approximately 2+ new trade lines or credit facilities being established. What's more or less not overt out there in the industry, but suggested by a lot of lenders, is that you also have approximately $2,500 in new credit available to you. One thing just to advise people of as they're going down this path, that in no case are secured credit cards or those prepaid credit cards that people often use are going to assist you to this end.
So when you say reestablishing credit then, and you threw out the number of $2,500, and I know you said we're speaking in generalities, obviously every situation is different. We're kind of just trying to paint a picture here. What kind of things then would help reestablish credit that you've seen?
So again, if you're looking at unsecured credit, you are qualifying based on your own merit. So that's where, sometimes people are so bad they need a secured credit card just to get a footing. But once they have that footing and the credit starts improving through the credit cycle, sometimes it's just as simple as starting with a small Capital One, Canadian Tire, MasterCard, one of those easy entry-level consumer credit cards that may be providing you $500, $700, or $1,000 in available credit. From there, we want to move back into a bank type of facility, either a MasterCard, Visa, or a small line of credit. And then again, it can be more organic. Sometimes people, even through the proposal or bankruptcy, have some surviving credit, a car loan maybe, and that can give them some footing to help speed that process. So again, there's no hard and fast rules here, but these are the generalities.
Cool. And so the final question I want to ask you then has to do with level of down payment. So let's take the person who has perfect credit. They, fantastic, never been bankrupt, never done a proposal, everything's fantastic with them, and they want to get a mortgage at the absolute best rates. They don't want to have to pay any kind of mortgage insurance, anything like that. What's the minimum level of down payment required in that scenario?
Well, if we're not looking at mortgage insurance, then today's best rates are going to be on a 20% down, because anything over and above, you will still even get a better rate if mortgage insurance is involved, because the risk is removed from the bank's shoulders and put on, well, it's effectively put on the taxpayer, but don't let anyone say that out loud.
Yeah.
But the kind of inverse system that we have here is that when the risk is removed, the lender provides a better interest rate, but that comes with a mortgage insurance premium. So there is a bit of a catch-22 there. If you want best rates and not paying an insurance premium, you're going to have to put down that 20%. So
20% if you've got perfect credit. Somebody who's got less than perfect credit but is willing to pay the insurance premiums, what's the absolute minimum you can get away with then in terms of a down payment?
The 5% down payment through mortgage insurance is still possible for those people if they met the minimum requirements. Just quickly, as a caveat, self-employed people will not. So unfortunately, regardless of their reestablished credit, they would, post-bankruptcy, they are just not a candidate.
It's more difficult. Okay, good. So 20%, if you got perfect credit, it is possible to get mortgages with as little as 5% down. Obviously, you're going to pay a little bit more for that. I appreciate that. Thanks very much, Mike. We're going to take a quick break and come back and talk more about mortgages right here on Debt Free in 30.
Looking for information on budgeting, debt consolidation, credit counseling, debt management, and debt settlement? For unbiased advice, go to moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. On today's show, we're talking about mortgages. I want to make sure we aren't hearing just one perspective, so in this segment, I've got another mortgage professional to help us understand how to qualify for a mortgage. So let's get started. Who are you and what do you do?
Hi, Doug. I'm Bev Gay. I'm with the Mortgage Group, and I've been a mortgage professional for 15 years. I've closed over 15,000 mortgages in my time, and I pride myself in looking at every situation and trying to find the best contract or mortgage product for their particular needs.
And before you were a mortgage agent, where'd you work? What'd you do?
I was a mortgage banker, and I loved that. And then I went to work for CMHC and for Genworth. So I have a pretty good perspective on all aspects of the business.
And what is CMHC? What do they do? What's their role in the mortgage world?
CMHC is known as the government mortgage insurer. So they insure mortgages to the banks. And basically you pay a premium in the mortgage payment for that, but it allows you to get a low down payment mortgage.
And so I need to get mortgage insurance at what level of down payment?
Normally, we say if you have less than 20% down payment.
Gotcha. So if I'm getting a mortgage with 10% down, 5% down, 15% down, there will probably be, almost certainly, there will be CMHC insurance that the bank will, in effect, tack on to the mortgage, makes the mortgage a little bit more expensive, but that protects the bank, and the bank probably wouldn't have done the deal otherwise. So
that's correct.
In order to get the absolutely best mortgage rate, I want to have a down payment of 20% or more. That way I can avoid the insurance. Is that a simple statement, or is that not correct?
You will get the same rate whether you have 20% down or 5% down. The down payment does not affect that. It's just that you don't have the insurance premium worked into your payments.
I gotcha. So the amount, as a customer, the amount I pay will be higher because I'm paying the mortgage interest rate plus the insurance premium on top of it. Okay. So in the first segment, we were talking to Mike, who's a mortgage agent as well, and he was walking us through what's required in general terms to qualify for a mortgage for somebody who has less than great credit. So I want to delve into that a little bit deeper with you because that's something that you've got some expertise in. So let's take the scenario of someone who has been through a proposal or a bankruptcy. As a result, their credit is damaged. And now they would like to start the process of buying a home. So I'm assuming that the day after my bankruptcy ends, if I have zero down payment, I can't just walk out and get a house. That's kind of obvious, right?
Exactly.
So what is it going to take then to get there? So let's pretend I've come to you in that scenario. My bankruptcy or my proposal just ended, and I would like to buy a house someday. So walk me through the specific advice you give me to accomplish that. What's the first thing I want to do?
All right. Well, every situation is a little bit different, so I will just give you on average. The very first thing that we want to do is meet and determine sort of where you could be and how we're going to get you there. The very first thing I want to do with you is to get your credit reestablished. Some people try to do that on their own and end up doing it incorrectly, or they go bank to bank to bank and have lots of credit checks on them, and that actually is more to their detriment.
Yeah, because every time your credit is checked, there's a note on your credit report. You went to 12 places and they all turned you down. That's going to make it worse. So you've got to do this smart then. So, okay, I want to start reestablishing my credit. What's a specific thing I can do then?
First thing we do is get you a secured credit card. And to be honest, if we have to start at $500, then we do that.
Now, just let me interrupt you there, because on our first segment, Mike said that, you know what, a $500 secured credit card is really not going to make a whole lot of difference. Do you agree or disagree with that?
I totally agree.
Okay.
Nowadays, to get a mortgage, they're looking for actually 2 items with reestablished credit with limits of at least $2,000 or $2,500. So even though you can only maybe get that $500 initially, after some series of payments, most often 12 months, then they will increase the limit to $1,000 or $1,500. If you are able to secure more, then we can get you a higher limit. Because what we're looking for, and what the credit bureau computer is looking for, that you pay on time every time, but the banks and CMHC are looking that you can manage a higher limit. So I work with you very closely on how we use that limit. So I suggest that, yes, maybe you have a $2,000 limit, but we're never going to go above maybe $100, because we're going to use it just to buy gasoline, because that's a budget item. At the end of the month, it gets paid back every month. The computer doesn't track how much you spend. It just knows that you pay on time every time. And the fact that you stay away from your limit also gives you a better credit rating. So doing that, it's steps, but it's steps getting you into the right place, which is buying your house.
So what I'm shooting for then is a history of making my payments, and I'm shooting for reestablished credit, a couple of $1,000, $3,000, whatever. And then obviously I have to shoot for a down payment. So as we talked about earlier, to get the best rates, to not have to worry about any kind of insurance or anything, I'm shooting for 20%. But it is possible to get a mortgage after a proposal or a bankruptcy with as little as how much down?
Really, with as little as 5% down.
With as little as 5% down. And obviously I'm paying the insurance fees and everything, so it's going to be a little more costly than if I had a larger down payment. So then the final step in that process then is to save money. Is that correct?
Right. And there is a but to that whole 5% down. It might take us 4 to 5 years to get there, but at least you're going to get there.
So if it's going to take, so that's my target then. I've got to get to at least 5%. Obviously more is better. How much is the house going to cost? How much is 5% of that? I do the math backwards. How much can I save every month? If I've got a fantastic job, or if my mother is willing to give me a whole chunk of money, how quickly can I then buy a house after a proposal or a bankruptcy?
It could be 1 day, 1 month.
If I got the bucks, I can do it quicker.
That's right.
But
or a good co-signer. Lots of different things come into the
scenario. So there are
scenario.
ways to do it. So the key point is, a proposal or a bankruptcy does not mean you can never buy a house again.
Correct.
You just got to be smart about
That's right.
it. So,
and it takes work.
It takes work. Yeah, I think that's a key point. So final question I want to ask you in the last minute or so we've got here. What about the person who is in the middle of a consumer proposal right now? A lot of people do proposals because they own a house. They've got a little bit of equity. They don't want to go bankrupt because they would lose it. Is it possible to borrow money against your house while you're in a consumer proposal to pay out the proposal?
Yes, and the way that works is basically the government put a new rule on this year that you can only finance 80% of the value of your house. So we look at what the existing mortgage is and how much money we can give you. If you've been in the proposal for 12 months, good repayment, then we can sometimes pay out that proposal, and maybe there's something else you want, you need a car or something like that. We'll put you with a lender that is not a bank, but will give you, let's just say, for example, 3.99% because you have 2 more years to establish credit. And then in 2 years, we can take you out to a mainstream lender.
So it's actually possible in the middle of a proposal, if you have equity, to get a refinance mortgage at a relatively good interest rate. We're not talking 20%.
Absolutely. We have lenders that are going to help you reestablish yourself.
Because they've got a customer for life now, probably. So you mentioned 80%. So just so that we're all clear, because before we said if I'm going out to buy a house, I can buy a house with as little as 5% down. But on a refinance, there has to be 20% equity. Is that correct?
Yes. Now, sometimes we do private seconds behind, and some of the lenders will let us go up to 85% or 90%
Gotcha.
with a private second
But
behind.
there's a difference between buying a new house and refinancing.
Exactly.
Excellent.
CMHC, of course, will not get involved in any payouts of consumer proposals or things like that.
Right.
So we have to have the equity or do a first and a private second.
Gotcha. Excellent. Well, that's great, Bev. I really appreciate you joining me today. What I'm going to do in the show notes, which people can find at hoys.com, is put links to your website so they can see how to contact you if they've got questions about how to refinance because they're in a proposal or they want to reestablish and buy a house in the future, how to do it. They can contact you. Thanks for being here today.
Sure, that's great, Doug. Thank you.
Great. Thanks, Bev. We'll be right back to wrap it up. You're listening to Debt Free in 30.
What are the warning signs of debt problems? Where can I find a free online debt options calculator? Where can I get free ebooks and guides? Find all the answers at moneyproblems.ca, the website for Canadians with money problems who want money solutions. moneyproblems.ca.
Welcome back. It's time for the 30-second recap of what we discussed today. On today's show, we talked about mortgages with my two guests, Michael Smele and Bev Gay. They both gave similar advice. It is possible to get a good interest rate on a mortgage after finishing a bankruptcy or consumer proposal, but it takes some planning and you do have to take steps to reestablish your credit. That's the 30-second recap of what we discussed today. So, what's my take on mortgages? What amazes me most of all is that as I record this show in the early spring of 2015, both mortgage experts told me that it is still possible to get a mortgage with only a 5% down payment, even if you have had a bankruptcy or consumer proposal in your past. My take is this. As we've discussed on previous shows, sometimes renting is the best option, but if you are getting a mortgage, I still believe that a bigger down payment is better. At less than a 20% down payment, you're paying mortgage insurance fees, which increase your monthly payments. So I think that in most cases, it's best to save for a bit longer so you can have a bigger down payment and lower your mortgage costs. That's our show for today. Full show notes are available on our website at hoys.com. That's HOYES.com. Thanks for listening. Until next week, that was Debt Free in 30.
If debt problems are keeping you up at night, if collection calls leave you afraid to answer the phone, it's time to end the cycle. You can do something about your debt. Call Hoyes Michaelis today at 310-PLAN.